We have Alan Nuckman, the Chief Market Strategist at Agora Financial. Welcome, Alan. Thanks for sharing part of a very busy morning with us here on the TD Ameritrade Network. Let's begin with the headline number. After the ADP number, expectations were high headed into this one, and it looks like it didn't disappoint. Talking 225,000, it looks like.
Yeah, pretty strong number. Now, you talked the whole last segment about why we look at this number. This is the best barometer of the economy. The stock market is not a reflection of the economy. That's where investors want to put their money. This is a viewpoint on what's really happening with the economy, and then the Fed can decide whether it be lowering or raising interest rates, and it's also a gauge that helps look at the inflation overall in the economy. So this is the big thing. You and I have been doing this for 30 years. This is the day.
Yeah. Alan, let's talk about this number. That 225, I mean, you mentioned how this is an indication of economic conditions. In theory, that's pointing to very strong economic conditions and really feeding into the narrative that we've been hearing from Fed speakers, specifically Jerome Powell most recently, made it pretty clear that the labor market remains strong.
Yeah, the labor market remains strong, but I think they do a better job of selling than anything else. Let's remember, 225 used to be what we expect on a monthly basis. And this administration in the last 3 years has created less jobs than the previous administration in their 3 years. So, but they do a great job of selling, and that's perception half the time. So that's how people feel, and they make people feel a lot better than the last administration.
All right, Alan, let's get into a few of the other individual components, because that's one of the things we've been focused on here today on the Future Show, is how it's not just that headline non-farm payrolls number. You mentioned that as well. I actually just noticed it looked like unemployment, the rate inched up to 3.6%. That was up from 3.5. We've been hearing about historically low unemployment and how the rate has been. Well, it looks like it inched up a bit, and it also looks like that participation rate inched up some as well to 63.4%. Maybe that explains.
Yeah, and also I didn't get a chance to see the number, but were there revisions in the last months? Because that's what's important to me, is to see where the revisions. The one headline number, like you talked about, usually is not that big a deal unless it's a complete surprise from expectations.
Alan,
then the key is, how does the market react?
Last month got revised to 147,000, it looks like.
Okay, so they went down, even though this is a bigger number than that. So the question is, when you stir this whole pot in this stew, how is the Fed going to react? Are they going to continue to be stimulative? There was a 50% chance coming into today that they would cut rates by July, and an 80% chance by December. So is that still intact? Is the economy too strong? Those are the things that people have to weigh out, and that's reflected in the price, and then we'll have to make those decisions.
Yeah, I want to take a look at how, as you mentioned, investors, well, you mentioned how the Fed's going to react. I want to take a look at how investors are reacting. I've got the bonds here. If we could just pull them up right now. After coming off the lows in the overnight session in the mid 160 handle, well, you can see they're currently in the mid, to upper extreme of the 161 handle. They're seeing some volatility, but kind of limited here. It looks like, Alan, up on the day by about 1/3%. Let's take a look at how investors are reacting to the number here in terms of the indices. You can see, Alan, we got a little bit of a lift up to that 33.45 level.
Firmness.
Very muted for the most part, though, a 5-handle boost. But I mean, I guess I think it's important to remember that we just posted a new all-time high prior to yesterday's day session trade and Thursday's overnight session, and we see it here, 33.57.75.
Yeah, that complete comeback in stocks was amazing. Yeah. You can call that a comeback. I mean, in less than a week, it erased that Friday fall and up and away, new all-time highs. So that projects 3,500 in the S&P. We've talked about that as the upside target. The stock market is nothing. Nothing will stop the stock market at this point until something does. So, but at this time, the momentum is very, very strong. And you're continuing to see, rates go down, and stocks go up, as that inverse correlation supposed to be, but sometimes it gets knocked out of whack and it gets disconnected. But at least now it's going the right way.
Hey, speaking of inverse correlations that are a little out of whack, let's talk gold, because we've been watching a strong U.S. dollar. We just had a robust jobs report, but we've got gold, which is still currently trading in positive territory. It seems to be shrugging off a lot of bearish news recently.
You had to go bring me up to the dollar, didn't you? The dollar traded between 96 and 98 for 3 months, and guess what? It broke out to the upside. So we're back in the same situation again. Yes, we're looking like we're going to cut rates And I think there are other levers that they can pull to be stimulative, and one is knocking the dollar down. But who knows? And the dollar just, it defies description and continues to do so. It hasn't made new highs. You know, that's a good thing, I guess. But if you look at the other currencies, the euro, new lows, the yen at the lows, the Aussie, you know, down at the lows, and the Canada giving up its gains. So the only other currency that's done well is the Mexican peso. The peso's up at its highs.
Yeah.
So the question is are these trends going to continue? Are we going to try and catch these turns? You know, and what's going to cause the turn? I don't even know at this point, but the dollar, I continue to say, defies description.
Yeah, it sure has. We actually just pulled a chart looking at gold and the dollar, which has been bid. Alan, today, again, diving into some of these individual components and market reaction too. We've been talking a lot about some of the individual components and how we pay close attention to them. Can you help us, again, talk a little bit about the impact that this could have in the bond market? Because one of the things, as you mentioned, rates have been really low or coming off. They seem to have lost some of that momentum to the downside, though, as of recent, the last couple days at least, this week. Talk to us about what a big number like this ultimately means for rates.
Well, you want to look to see, I didn't see the hourly earnings, but everybody's been waiting for hourly earnings just to spark some inflation, but we're just not
up a bit,
getting
Alan.
any.
They inched up,
you know, but
3.1% for the year over year. It looks like month over month came in a bit below expectations of 0.3, but that was above last month's number of 0.1.
So there's a little bit there. But the question is when?
Yeah.
When is that going to actually impact, you know, inflation? And that just hasn't happened for whatever reasons. It's never caught up. It's never put that pressure point. So that's one of the things you always look at. I talked about the revisions. We talked about participation rates, and then you look to see how the markets react. And that's, we've always used as young traders, we use the bond market as the barometer for the, you know, how the markets are feeling, and that was really the gauge of everything. And now I think a lot of people have focused their gauge and their sentiment maybe more on the VIX, and the VIX in the last week went from 20 last Friday all the way down to the below 15, down to the 15 handle. So it gave up 25%. As we've seen over and over again, it's a whack-a-mole game. Every time there's a VIX explosion, it gets whacked right down until it doesn't. But that's been the case where the VIX has been coming down and the stock market's been going up. And so using bonds as a economic sentiment, that's probably decreased a little bit. But let's go old school and use that as a way to see, you know, to see how traders are truly feeling about the economy.
Alan, I'm glad you brought the VIX into the discussion, because that's basically where I was headed next. We've got the indices into recent new all-time highs. Again, I just mentioned 33.57.75. I'm showing the ES here on the left. I've got the VIX futures on the right, still holding right around 16. Does it concern you to see gold holding near upper levels, shrugging off some of the bearish concerns as we've already talked about, and seemingly the VIX, for the most part, shrugging off some of these bearish, or what could be bearish indicators for the VIX? I mean, in theory, with indices at new all-time highs, I'd expect to see the VIX around 9 or 10 at the very highest.
Right. That's what I've been waiting for. We still have not seen anywhere near an attempt on those recent lows in the VIX. The lows in April of last year were 11. The lows below that, we were at 9 and some change a few years ago. So even though the stock market, the S&P, continues to make new highs, we're nowhere, absolutely nowhere near the lows in the VIX. So there's something out of whack there. Now, does that mean there's a lot of downside potential in the VIX, meaning there's more upside potential in stocks? That's the way I look at it for now. We're continuing to see a series of lower highs in the VIX. Even with this global pandemic concern, the VIX peak was 1999. You know, let's go back to December of 2018 when we had the stock market selling off and the China trade concerns. The VIX spike there was 36. So a global pandemic was a minor blip in comparison when it comes to the fact of the fear number. I know a lot of people are more fearful than that, but when you look at it factually as the fear number, it was nowhere close to where it was just a year ago.
Yeah. This is something to watch here. We'll continue to watch volatility. We'll continue to watch the indices into new all-time highs, market reaction to today's jobs report. And, well, Alan, really appreciate you joining us here again on a very busy Friday morning to help us break it down. Traders, that's Alan Nuckman, the Chief Market Strategist at Agora Financial.